Perfect. Hello everyone. So on behalf of the Office of Alumni and Parent Engagement here at Bryant University, welcome to our third webinar this fall designed to share professional expertise with members of the Bryant community. Before I turn the program over to our presenter, Linda Thalheimer, and our facilitator, Robin Ward, just need to provide you all with a couple of pointers for today's webinar, which will last for approximately 1 hour. All participants are in a listen-only mode. However, we do encourage you to comment and ask questions using the question and answer feature located on the control panel of your screen. Linda will go through her 30-minute presentation, and then we will have a question and answer opportunity where Robin, our facilitator, will forward as many of your questions to Linda as time allows. As you can already see, this webinar will utilize a live video feed from our presenter. The video can be resized based on your preference by simply clicking and dragging the divider located in between the video and the slideshow. After today's presentation, you will receive a very short survey. Please do take a moment to provide feedback because your comments are valuable as we expand our professional development program for members of the Bryant community. Now, I will turn the program over to Robin Ward, Director of Alumni and Parent Engagement at Bryant University. Take it away, Robin.
Thanks so much, Tyler, and welcome back, Linda. It's great to have you as our speaker today. Again, I'm Robin Ward. I'm the Director of Alumni and Parent Engagement at Bryant University, and I'll tell you just a short story. I met Linda probably about 5 years ago, shortly after my husband and I had signed up for long-term care insurance. And I was so sorry that I hadn't met her ahead of time because she represents not just one company, but really has the broad range of knowledge about all the products that are out there. And so in our quest to always be careful not to highlight one alum's company over another alum's company over another alum's company, she brings everything together and gets you the information you need, and then we'll be talking about that today. But Linda has been specializing in long-term care insurance for over 17 years, so she's been in it pretty much since the beginning, right? She has an undergraduate degree in occupational therapy. An undergraduate degree in occupational therapy from Tufts University and a master's in healthcare administration. This background gives Linda a unique experience of working from both the patient care and claims perspective, as well as from the insurance sales perspective. And because of this background, she is not only better able to pair individuals and companies, that was my experience, with the most appropriate and cost-effective policies, but she can also find the insurers most likely to approve and underwrite their clients. She's able to talk the medical language necessary with underwriters, resulting in efficient communication for better ratings and appeals. I've found Linda to be very honest, very straightforward, diligent, detailed-oriented, and knowledgeable, and she has worked with other Bryant alumni to find the right solutions. So right now, I'm very happy to turn the microphone over to Linda and today's presentation. As Tyler said, I'll be moderating the questions, but we will do those at the end. If it's something simple that I think I can answer, I will certainly jump in. But right now, I'll turn the show over to Linda. Thank you.
All right, thank you. And I'm very happy to be here. So every day, medical science creates more and more ways for us to live longer. Now, is anyone surprised if you live to, oops, there we go. Is anyone surprised if you live to 80 or 90 years old? Are we even surprised when we hear people living to 100? Not anymore. The truth of the matter is, when we don't die, we live. And when we live and we get older, we need care. And that care is very expensive. So living a long life is now a near certainty. Planning for it is now a necessity. Well, welcome everyone to the webinar. And again, my name is Linda Thalheimer. I've been specialized in long-term care for over 17 years, and for 16 years I worked as an occupational therapist and manager of rehabilitation. And I can tell you that no one ever expects to need care. My patients were healthy, and then they were not. Had I offered them insurance the day before they were admitted, few would have taken advantage of this opportunity. So today I'm going to provide you with education, but I am also here to provide you with education benefits and quote information. I'll focus on the education for this seminar, for the webinar, and then after the webinar, I'm going to provide you with a link that you can sign up for free consultation on product design, product options, and quotes. So, long-term care is such an important topic because we're not surprised when we live into that old age, and we're not surprised when old people need care, and that care is expensive. But today we're going to try to figure out, is it better to insure or not? Now, if we need long-term care and we purchased insurance, that was obviously a good idea. And if we never needed or never need long-term care and we didn't purchase insurance, those are good plans. But there is no crystal ball. So the real question we have to ask and answer is it better to not need and have purchased long-term care, or to have needed long-term care and not had the insurance? That's really the big question that we have to answer. Now, to figure out the value of long-term care insurance, it's important to understand what it covers and how it works. So let's start with the basics. Long-term care insurance is comprehensive. It pays a daily or a monthly benefit for a duration of time for home care, assisted living, nursing home, hospice, and most policies today have an alternative plan of care benefit that pays for appropriate settings that are not necessarily even identified in the policy. Now, to qualify for long-term care insurance, you need to acquire assistance in 2 of 6 activities of daily living skills. That includes bathing, dressing, toileting, feeding, transferring, which means moving from, say, a bed to a chair or a chair to standing, feeding oneself, and continence. Or it could be that you have a cognitive impairment such as Alzheimer's. And a severe cognitive impairment means that you cannot live alone safely, that you might mismanage your medications, you might leave food in the refrigerator until it spoils and you have no idea that what you should be eating and what you shouldn't. You may wander out of your house and not find your way back. So there are times that people can perform the 6 daily living skills and still require assistance and supervision because of a dementia. There are basically 3 funding options to fund long-term care: Medicaid, self-funding, long-term care insurance, but if you notice, Medicare is not an option. Now, the reason Medicare is not an option is because Medicare primarily pays for skilled, not custodial care. And you can remember this because Medicare's last 4 letters is CARE, and that's medical care. The skilled care provides home care only in situations in which you already have skilled care nurses or therapists in the home, and that's typically for a very limited amount of time. It does not pay for assisted living. It does not pay for adult day health. It typically pays for the one place that people don't want to go, and that's only up for that first 100 days of skilled care. And once that skilled care is over, or that 100 days is over, Medicare no longer pays for a nursing home either. Now, Medicaid is the federal and state-funded program for the poor, and you can remember Medicaid from Medicare in the last 3 letters of Medicaid, which is aid. Medicaid is financial aid. It is when all your investments are depleted. There is very limited home care, very limited adult day health, and assisted living. It primarily pays for the one place no one wants to go. And unfortunately, nursing homes are not as high a quality of care as they had been many, many years ago. The healthy, wealthy elderly stay in assisted livings, they go to continuing care communities, and they stay in home care, leaving the very sick and the very poor in nursing homes, which are much more difficult to manage financially. Now, Medicaid requires a spend down, which means that if you have money and you've done well, you will be paying for your own care. Even if you could spend down and get rid of your money, I strongly am recommending that you plan a way to pay for your long-term care privately. And that's probably the most important message that I can give to you today, is to plan that you want to pay privately for your long-term care, because very few of home care companies and very few assisted living settings will accept Medicaid. And the assisted livings that do accept Medicaid usually accept people in on a spend down level. In other words, they have very limited beds for Medicaid, so they typically take people in privately and have them spend down to Medicaid, and those beds don't open up very frequently. So what ends up happening is that people who are on Medicaid end up in nursing homes or end up in home care where families are the primary caregivers. So the real question is, how do you want to fund your long-term care? Now, most of us are familiar with the concept of insurance. And in fact, we use insurance all the time, and we're really just thinking, oh my gosh, not another insurance that I have to have. But there is a purpose for insurance. We have our auto insurance to protect our car and to protect our liability when driving. We have property insurance to protect our house. We have life insurance to protect our family and disability insurance to protect our income. Many people have lots more life insurance to protect their wealth. But what is protecting your portfolio at retirement? And it's only your good health, because as soon as you need care, you have to spend that portfolio to pay for your own care until you become indigent and ready for Medicaid. Now, the government recognizes that long-term care is a problem, and it is a financial burden to the state and to the federal government. So they created what's called tax-qualified long-term care policies. And most states only are allowed these states to sell qualified long-term care policies, but it's always good to ask. A tax-qualified policy means that the benefit is received tax-free. In addition, for self-employed and for corporations, there are also tax-deductible premiums. And there are very specific rules to those. But when we talk on a separate individual session, depending on where you lie in the self-employment or corporation world, I can help you with those. And you can also talk to your CPA. It's a one insurance policy similar to health insurance that you can take a deduction on the premiums and still receive the benefit tax-free. Okay, so another benefit of a tax-qualified policy is the Mass Health Lien Law. So if you live in Massachusetts, the utilization of a long-term care policy is very different than in other states. Massachusetts has what's called the Mass Health Lien Law, which protects a primary home in Massachusetts up to about $860,000, and that increases every year. And what that means is that if you needed to spend down onto Medicaid, they would allow you to keep your home if you have a small long-term care policy. And when you died, the lien would be lifted from the house, and that home would not be expected to pay for the Medicaid expenses that had been expended during your lifetime. That home would be able to go to your heirs. So it's a really very, very valuable option in Massachusetts, an easy way to protect a primary home in Massachusetts without a trust. Now, most other states have what's called a partnership program, and the partnership program is also a Medicaid protection program for you, in the sense that it allows you to protect the value of your long-term care policy that you are paying for long-term care against Medicaid. So let's say you have a $500,000 long-term care benefit. So you spend $500,000 from your long-term care benefit, and now you need to go onto Medicaid. You can keep $500,000 above the Medicaid limit as protection because you purchased a partnership long-term care policy. And there is no limit as to how much how many assets you're allowed to protect. So if you have $1 million policy or a $2 million policy, you can guarantee yourself that you can protect those for your heirs based on that benefit of your long-term care policy. So people wonder about product design. How do you decide which product, and how do you decide which design you want? Well, there are basically two types of long-term care policies. The most traditional is the standalone long-term care policy, and then you have the combination, which is the life and the long-term care policies. So a standalone long-term care policy is usually a use it or lose it policy, although there are some that have return of premium riders. Basically, this is a bigger bang for your dollar where you have a lot more long-term care benefit for the premium that you've paid. In contrast, you can have a combination product that combines a life insurance aspect with a long-term care benefit, so that if you don't use the long-term care benefit, you will receive the return of your premium or potentially more depending on the way the product is designed. So based on your perception of risk would determine whether or not you get a standalone product or whether you want some type of return of premium if you don't need the long-term care. Another consideration for your product design is the underwriting considerations. So a standalone long-term care policy will be underwritten based more on morbidity than mortality. They don't care, they're not concerned if you die, they're concerned if you live and need care. Where a combination life long-term care product, their actuaries tend to go more towards the mortality and also take into consideration the morbidity of a client. So they tend to be a little bit more liberal in the underwriting considerations, so that someone who may not necessarily be able to get a standalone long-term care policy may be able to get a combination long-term care policy. Now, when we think about underwriting, underwriting is very tough. So I just wanted to throw in this whole concept of underwriting to let you know that there are products out there that will take people with significant medical diagnoses. They're not the traditional standalone long-term care. They're not tied with life insurance. They can be tied to annuities, and there's even a home care product that is not insurance that will pay for home care for anyone who is independent at the time that they purchase the product. So they can even have a diagnosis of Alzheimer's if they're still driving and still making their own meals, but in that moment they are independent and not using care. So it's good to just have that information to know that there are options along the continuum of underwriting considerations. So people always ask me, what does long-term care cost? And the reality is that it varies based on your age, your health, your partner status, because there are discounts if people have a partner or if the partner actually applies. It depends on the type of product, it depends on the benefit design, and of course it depends on the riders. There are a lot of riders on long-term care where you can have shared care, and you can change the deductible period so it starts earlier or later. So inflation protection, to inflate your policy so that it increases over time and has more value in the future than it does today, or as much in the future as it has today. So all those things impact the price of a product. But when I think of cost of a product, the reality is long-term care is, the utilization of long-term care is an expensive proposition. And it is a high risk that people will use long-term care. So most people will be purchasing a long-term care product based on premium as opposed to benefit. The more benefit you can purchase, the happier you will be when you, or if you need to go into claim. So what I usually ask people to think about is, what is affordable premium? What do you feel that you could afford on an annual basis that you could feel comfortable spending for your entire lifetime? And that will give you an indication of what your premium is going to cost, and then we can work backwards into what are the best options for you. And of course we take into consideration the state in which you'll ultimately live, because states in the south are certainly less than states in the north. So depending on where people live in the country will depend on how much money they need in their long-term care to fund a long-term care event. And I have people who are spending very little in long-term care. They're staying at home. They're using about $3,000 a month. And I have literally several people who are spending up to $23,000 a month in long-term care. And it's because they have money. They have a large long-term care policy. And then on top of that, because they were wealthy enough to purchase a large long-term care policy, they are also able to supplement their long-term care policies to provide up to 24-hour care in a beautiful, expensive facility. So as I said, the more money people have, the more they will spend. Now, long-term care is much more than just money. It provides direction. When people have a long-term care policy, it takes away the burden of the family to make the difficult decision of whether they're going to provide care themselves or if they're going to hire care. And distribution of long-term care responsibilities is rarely equal or fair. If families are deciding who's going to provide care for the mom or the dad, it is usually the daughter, or the one who lives closest, or the one who doesn't have children, or the one who doesn't travel. I mean, there's always some reason why one child may have to take the primary care of the parents over another. And because it's not fair, and it is often difficult and stressful and emotional, it can impact family relationships. So, when care is prepaid, not only are you giving permission for your family not to provide care, you are giving them a direction to hire caregivers. There will always be something for family members to do and to organize and to coordinate. But having a funding source to allow them and encourage them to use professional caregivers will help them care for you longer and better. Now, clients will always tell me, I don't want my kids to care for me. But the reality is, they really don't want to, but they will. Other people tell me, my spouse will take care of me. And if they're not too frail, they will too. But remember, caregiving can be a heavy physical burden, and it can be a very emotional burden, especially when there's cognitive impairment and it impacts behavior and memory and judgment. So providing care can make the caregiver sick. And when things aren't working, children need to come back into the situation. Now, there are a lot of people who don't have children, and those that have children may not have them in the same state or even in the same country that they can help with physical or coordination of caregiving. In these situations, geriatric coordinators can be hired to help coordinate care, but more frequently, people who don't have a partner at that time or children available will often choose to enter a facility prematurely. And this can be very expensive. And this is where people often go into continuing care communities or into assisted independent living that they can graduate into assisted living communities. So the question is, what is the plan? And very important to sit down and think about, if I were to need care, what would I want my plan to look like? Who would be the one who would coordinate? Who would be the one to organize the funding? And where would I want to be? And what would that look like? Who would need to be involved? Long-term care insurance policies do include some coordination of benefits, so they can help you identify home care agencies and assisted livings. They don't direct, they don't tell you what you should have, but they can be an important resource to you and to your family, making the planning process easier. Now, many people say to me, I can self-insure. And they could. But the question is, do people worry when the stock market goes down? Well, wealthy people do too. And the problem with long-term care is the account goes down and it's never coming back up. And some people say, well, that's okay because I don't need my money. If I have so much, it's okay if I run down to my last nickel. The problem with that is that if you want to use your last nickel, you need something to fund long-term care, so that should you need long-term care, which is typically at the end of your life, you have a lot of money to provide you with the type of care that you would want to be in the way in which you would like to be cared. So you can't spend that money. So you can't die with the last nickel, because you have to have this whole portion of money allocated to long-term care. A long-term care policy gives you that bundle of money so that you can spend your money more efficiently and freely while you're living. Now, some people say, I really don't want to spend that premium because I'm trying to protect the money for my kids. And there's enough money that they can make that decision at that time. And again, this is a double-edged sword to your kids because they understand you want to protect their money. They know that you want to leave it to them. So then they're stuck with that difficult decision of, do I provide care or do I hire? And that can be, and not, that decision alone can be very emotionally draining to the family, and not all kids will agree on what that decision will be. So if you need long-term care, you will use more than your long-term care policy. So having a long-term care policy and never needing it is good for the entire estate. Much more will be left to the kids if you never need long-term care, even if you have a long-term care policy. On the other side, if you have a long-term care policy and don't need it, you know exactly what's coming out of the estate, and the kids know exactly what has been allocated to them, so that they don't have to think in the back of their mind, oh my, I'm spending down my inheritance. And if they are having financial difficulty, or their children are having financial difficulty, it is harder to spend down their inheritance, knowing that that they could protect it if they just provided that care themselves. So the long-term care policy plays a very important role in directing the families of how to manage your care. And for people who just think, I just can't do this, if I don't know that I'm going to use it, that's when the linked products are very, very effective, because they leverage your money anywhere from, depending on what age you purchase, anywhere from twice, if you're in your older years, down to 6-7 times the value of what you put in for long-term care, much greater than you could ever invest for a long-term care benefit. And again, that benefit would be tax-free in most situations. So it's all about sharing the risk. And you can share the risk at any level. You can have a very little policy just to take care of the front end of long-term care when it's most chaotic and stressful, when people are in home care and a new illness or injury occurs and there's a lot of emotion and you don't want major financial decisions made. All the way to long policies that have smaller dollar amounts that sort of offset the risk for a very long period of time. And to any level that feels comfortable in terms of a long-term care plan. People ask me, what age should I be thinking about long-term care? And the answer I tell people is it has nothing to do with age. It has everything to do with finances. Because at any age, you can be healthy and then you're not. So I have young people in their 20s who have long-term care insurance. Some of them have purchased it themselves through employer programs, and some of them have been purchased from parents as an extension of health insurance for their children. Having worked in spinal cord injury, I can tell you that the majority of my patients were young. The idea behind the finances is that you should be putting money away in your retirement portfolio on a regular basis so that you can have a good indication that you'll be self-sufficient in old age, and that you shouldn't have any major debt outside of a home, a car, and possibly college expenses. So those are debts that people carry for long periods of time, but as long as they're carrying those debts and they're able to still put money in their retirement accounts, then it's time to be thinking about long-term care protection. And there are policies you can buy that you buy without inflation protection or future purchase inflation, such that you could buy it when you're 25 and at 50 years old, inflate your policy at your 20-year-old age and your health as a 20-year-old. So there are a lot of options to be able to preserve your health when you're younger and still be able to inflate it at a later time when you're older. And that can be for people who have college-age children in their 40s and 50s, and they're thinking, I'm not really ready now to spend that kind of money, but I know that at any point my health can change, and then they can inflate it into the future when they're 60 or 70 at that earlier age and health, although it is more cost-effective purchasing the inflation in on day one. So the other thing I always want to tell people is that we are in the age of electronic medical records. Everything you say can and will be held against you when you apply for a long-term care policy. Your doctors do keep confidentiality between of what you say, but when you apply for any insurance product, you're waiving that confidentiality, and your medical records in full are going to the insurance company for their review. So that's very important for people to realize, and they need to know that when they're talking to their doctors, they need to make sure they're talking about real issues and not as much concerns. So something to keep in the back of your minds. So today we covered a lot of information in a very short amount of time. So I'm sure there are going to be lots of questions. But the key important factors of long-term care is this, is that it leverages your income and assets. You can have a lot more long-term care benefit with a long-term care insurance policy than you can through straightforward investment. There are incentives, tax incentives, to purchase long-term care. It's an important aspect of financial planning, providing direction to the family. And there are many options based on your perception of risk so that you can feel comfortable at any level of coverage. So to learn more, I have up on the screen my website, my email address, and you can also click on the link for my Time Trade account, which has my schedule. So you can just go in there, click on a time frame and a date that works for you, and then we can do this video chat one-on-one and go over the details of product design and premium cost. So thank you. I'm open for questions.
Perfect. Thank you, Linda. I'm going to turn it over to Robin in just a second. I just want to remind everyone that the questions feature is located on the GoToWebinar kind of control panel that you guys see either on the left or right of your screen. So if you guys just have a question to ask, just open up the questions module and ask that, and then Robin will give the questions to Linda to address. I know a lot of you will have, I guess, more detailed questions or private questions, so we'll keep this slide with Linda's contact information up. So if it's something that you'd like to ask her directly, please reach out via her scheduling, her email, and everything there. All right, take it away, Robin.
Thank you, Tyler, and thank you, Linda. And we do have some questions. I couldn't help, but I think we all, as you were going through your presentation, we all have gone through personal experiences of seeing our parents spend down and go through all of the steps for those last couple of years. I realized maybe I need to move to Massachusetts, though. It sounds like Massachusetts has some pretty good programs. I have a couple questions up here. I had one myself. I'm going to start with a question that just came in. Could you just describe what the main differences are between long-term care and disability insurance? Are they used interchangeably? Yes.
Oh, no. Very good. Very, very important question. So most employers offer disability insurance, and this is not long-term care insurance. Disability is replacement of income. So as long as you're working and you have an income, you're eligible for disability insurance. Once you retire, or if you're unemployed, disability insurance, there's no income to replace, so it goes away. So long-term care insurance is to pay for caregiving. So it certainly can be used in conjunction with disability insurance. In other words, if you become disabled, you have your disability insurance that funds your income to pay for your electricity and your mortgage and your food, and you can have a long-term care policy that pays for the care that you may need if you're disabled. So very, very different insurances, and it's important that you understand that distinction.
All right, thank you. I have a question here. It's about the write-off fee. I think we were talking just a minute ago about the tax incentives, and that was actually new to me. This may be, you may need to answer this questioner personally, but she bought a long-term care insurance policy within the last year, and one of the considerations was to have insurance that would cover outside the U.S. if she chose to retire there. Sounds like me, but it wasn't me. And so she bought and paid an upfront premium as a lump sum, and which entitled her to a greater amount of long-term care. So where the lump sum was $32,000, entitling her to $180,000 in long-term care. Was she entitled to some sort of a write-off when she did this in 2016? Is that a question that you'd be able to answer on air, or do we need to have her contact you directly?
So that is, so there's, it's, I'm not a tax accountant, but I can tell you this. So you definitely want to talk to your accountant. I actually asked that question. I called the IRS for single premium to ask them, does this have to be an annuitized deduction, or can it be taken as a lump sum deduction? And, you know, just for my own education as a specialist. And they told me, ask your CPA. So I've talked to many CPAs, and they all have their own opinion on how to deduct single premiums or 10 pays. And so it's one of those things that you ask your CPA, and it's up to the CPA to defend their perspective on the tax deduction if you should ever get questioned. And that's really because it's a very gray area with lump sums.
Well, we may have some CVAs online here, so we'll see if anybody weighs in. The next question is, does the VA, does the Veterans Administration provide any long-term care products or offerings?
Yes, they do. And I actually had the Veterans Administration as an option on a previous slide presentation. And I took it out just because very, very few of our present day clients are using the veterans benefits because they're very difficult to get access to. So, and so oftentimes they'll use a long-term care policy in conjunction with their veterans benefits. There are veterans benefits, and many people are using specialists to get access to them. There's usually a long delay before you can get them, but they will go pay retrospectively. So many of them are impacted by your own your assets or income. So it's very individual. It is, if you are a veteran, it's absolutely worthwhile, and I strongly encourage people to call a veterans benefits agent to get that information, because there are benefits for veterans, and but oftentimes veterans will get their own long-term care policies in addition, or because they make too much money and have too many assets to qualify.
All right. Okay. Thank you. Can you talk about the option of using a whole life policy with a rider that allows you to tap the death benefit to cover long-term care if you meet certain criteria? Certainly. Repeat that? Yeah.
Yep, no, I understand. No, no, absolutely. So long-term care can be a rider on any number of life insurance policies, and you know, typically long-term care is used effectively on a universal life policy that has literally, you know, basically no cash value. So it's either you die, or you use long-term care, or you die and it's left as a death benefit, or some portion of that death benefit is left behind, depending on how much long-term care you use. A whole life policy plays multiple roles. It has cash in it. You can grow cash that you can withdraw, or you can use it as a death benefit. And a long-term care rider on a whole life policy allows you to take some of that death benefit to use for long-term care. If it's a true long-term care rider, you can take it tax-free as a benefit. And what was I going to say? I was going to say, so the thing is that depending on what you want from your product will depend on how you want to choose your benefit. If you want a large long-term care benefit, it's going to be the most expensive on a whole life policy because you've got a life benefit, a cash benefit, and a long-term care benefit incorporated in one product. On the other hand, if you have a whole life, you're going to be purchasing a whole life policy, it absolutely makes sense to put a rider on it because the money that you get from a whole life policy will be a cash benefit, and that is very flexible to use in conjunction with other long-term care benefits. You know, so that if you're using a long-term care benefit for an assisted living and you want to bring in a private aid from a home care agency, that cash benefit from that whole life policy is a great added benefit.
All right. Good. Thank you. I've one other question here. This is about the premiums. Are premiums typically paid every year for the life of the policy, or is there a policy payment for a limited time? This questioner seems to remember a 10-year premium payment, but a benefit amount that continues to grow. That sounds familiar to me as well.
It is. So you can pay your premium in any number of ways depending on the company that's offering the product. So you can pay monthly, quarterly, semi-annually, annually. You can pay annually until you go into claim. You can pay annually for the life of the policy if you never go into a facility. I mean, so depending on how the contract is worded. You can pay in over a 5-year period, a 10-year period, a 20-year period, or you can pay in a single lump sum. Now, the payment of your premium is different than the way the policy inflates. That's based on inflation protection. So you can buy a policy with no inflation, such that whatever you have on day 1 is what you're going to have on year 20. You can get simple inflation or compound inflation. You can get future purchase option inflation, so one that you purchase at a later date. And so every company has a little bit of nuance on how they, on the benefits they offer and how those benefits are unique to their product. So, for example, elimination period. If you have a 90-day elimination period, it does not mean the same to every company. For one company, it can just be counting 90 days. That's called calendar days. For others, it could be called a service day elimination, in which for every day that you receive care that would have been approved by that policy had you gotten past your elimination period, would count towards that elimination period. So if you only used care 3 days a week, your 90-day elimination period would actually be longer than 180 days. So it's important to understand what the nuances are of each product. I mean, some products, there is a 90-day elimination period, and home care can start on day 1 or day 20, and others you're not starting until day 90. And sometimes it's a rider, and sometimes it's not. I mean, so so it's really important to understand the contract behind each insurance company. You're not just looking at a chart, at a table, and looking across and looking at the premium, because it's not a comparison of apples to apples.
Oh, it gets more complicated all the time, doesn't it? I was actually thinking along these lines, thinking of my own policy. It seems to me that should I need it, it's a lump sum available to me every month, and I use that however I choose to use. It certainly would not cover all of inpatient care. Is that typical? I mean.
So yeah, so some of the older policies were indemnity or cash benefits, which are more flexible than reimbursement policies, which are more common today. So a reimbursement policy is one at the end of the month you submit your bills, your invoices, and then the company reimburses you on those invoices. And you made another comment in terms of a monthly benefit. So some companies pay on a monthly benefit, and some pay on a daily benefit. And in a facility, it really doesn't make that much of a difference because every day is basically the same cost. But in home care, it can make a difference. Sometimes weekends can be more expensive, or maybe one day you use more care than another. So depending on the amount of your daily benefit would depend on whether it's really important to have that a monthly benefit versus a daily benefit. You know, so for example, if you spent $100 one day and the next day you spent $200 and you had a $150 benefit, on day one, that extra $50 would go to the back end of the policy, increasing the duration of your policy. And on the day that you spent $200, you would be spending $50 out of pocket. If you had a monthly benefit, all 3 of those days would be paid.
I think I have to go back and take a closer look at our policies and see what I have.
Just, you know,
I do have another question here. Yes, go ahead, Linda.
I was going to say, for anyone who has a policy, or a parent has a policy, or a friend has a policy, I am happy to review policies at no cost. They can be scanned to me, faxed to me. We can go through them on a video chat, and I am happy to tell you what you have in your policy and how the policy works, so that you know how to handle it when you go into claim.
All right, good. That's very helpful. Thank you. I have another question here, Linda. We have an alum who was turned down for a long-term care policy about 10 years ago. There were several mitigating factors: back injury, some anxiety issues, long-term use of pain and depression meds. And he's asking if things have changed since then with respect to being approved or denied with these existing conditions.
So traditional long-term care policies are much harder to get than they were in the past. So a standalone long-term care policy is harder today to get than it was 10 years ago. Even the linked products tend to be harder to get than they were 10 years ago. But there are new products that are designed differently, that are more accommodating than what was available 10 years ago. So there are products that would be available to him. They may or may not be traditional long-term care concepts in his mind. Relate to what exactly he was looking for, but there are alternative options to definitely look into and see if they meet his needs.
All right, good. And the next question that I have relates to another question that I had. The question is there a limit on the amount that the annual premium may go up every year? And I was thinking about that as well. It seems like, and this may be related or not, it seems like there are fewer companies in the business now. Maybe I'm wrong about that, or I've often wondered what if the company that I have would stop offering. But anyways, maybe if we can answer his, is there a limit on the amount that the annual premium may go up every year?
Technically, no. There is an inherent non-forfeiture in most long-term care policies, which basically says if the premium goes up too much, then the company is obligated to reduce the benefit so that you can maintain a premium. Now, all the companies, in any rate increase that has taken place, the companies have been amazingly responsive to the customer to make sure that they have options on how to manage their policy. And I'll say that the industry has gone through a lot of changes. There are growing pains in the long-term care industry. And it's not dissimilar to what the disability insurance companies went through in the late 80s. But nobody remembers. We're quick to forget. And 5 years from now, people will even forget that there was even rate increases in the long-term care industry, I'm guessing. But and so, in the late 80s, disability went through a chaos, and there were probably about 80 disability companies, and now there are just a dozen about. And they created non-cancelable disability policies so that rates couldn't be increased on existing policyholders. It was a real chaos in an industry, and now people don't even think about it. A lot of people buy just guaranteed without the non-cancelable riders on disability policies because there hasn't been, significant rate increases on disability policies, in the last 15 years. So, and I look at disability as very similar to long-term care, because long-term care is much more a morbidity product like disability than a mortality product like life insurance. And I think that's where a lot of the life insurance companies who were offering long-term care products got into trouble, is that they were really not clear about the actuarial design of these products. And they based it on very high interest rates when they were introduced. They based it on an industry standard that people dropped their policies about 5%. So in other words, most people who buy life insurance policies and disability policies buy them, and about 5% of them will drop them before they ever need them. So that's good for an insurance industry, because they're getting money with no risk. And in the long-term care industry, people who purchase their long-term care policies recognize their value, and they just weren't dropping them. So very low drop-off rate for long-term care. And they got the utilization wrong. Originally they were thinking much less utilization. I mean, it's almost a 50-50 chance that you're going to use long-term care. So all of those things have been adjusted for in our present-day long-term care policies. They know that men are likely to use on average about 2.2 years, and women about 3.7. And if it's a dementia, it doesn't matter what gender you are. It's on average it's about 6 to 8. So they've got a lot more concept about who's using the policies, how long they're using the policies, that interest rates can be very, very low, that people aren't going to throw them away once they have them. So that it's an industry, insurance is an industry that of large numbers, of figuring out, in a crowd of 100,000, how many people are going to use this and for how long. And the industry is getting much closer to that answer. And we see that with new companies coming into the marketplace. So while many people left the industry because they just didn't know how to make it work, now companies are starting with long-term care because they're starting clean. They've got all this information from the history of long-term care, and I truly expect more companies to start getting more into the industry now that the indices for pricing it are much more clear. So I hope I answered all the questions.
Yes, you did. Yeah, no, I've got a little summary here. We have one last question. I think we'll wrap this up. But we have an alumna who's asked: is there an income minimum at which long-term care is simply not affordable? We did talk an awful lot about wealth and other factors. Do you have a litmus test for someone's income?
Yeah, well, so it's very individual in the sense that people have very, very different lifestyles, and some people have greater needs than others, and it sometimes amazes me at how independent people can be financially with so little money over their entire lifetime. And so, the answer is, if you expect to be self-sufficient, so that you don't expect that you will ever need to be on Medicaid, where you'll be on a government program, then long-term care insurance is a consideration. If most of your money is in your home, then it certainly should be considered a consideration, especially in Massachusetts, because of the Mass Health Lien Law. But that would be the biggest factor. If you think you can be self-sufficient, then you have something to lose. If you think that you're going to end up on Medicaid and government funding, then long-term care really doesn't make much sense, because then Medicaid would help you with your long-term care, and that's I mean, it's just going to be a much more difficult financial journey. So yeah, I would not have somebody purchasing a long-term care policy if they did not have adequate funds to be self-sufficient in old age.
Yeah. Well, and I think, that is really important. I don't think anybody imagines that they're going to completely run out of money, but I saw the same that happened to my mother because she lived to be 97 years old. At 95, the money ran out, and that was something that if you'd talked to my parents 20 years ago, they never would have imagined. So I think that, as you said, we're living longer to have some of these products in place. This has been fabulous. I have a lot more questions, I think, myself than I had going into, so I'll certainly be following up. I just to summarize a couple things. Looks like we need to talk to our own accountants about the possibility of tax deductibility.
Absolutely.
States do have different provisions. You mentioned Massachusetts. I know some of the people who are online live in Florida and Illinois and a few other places. So there may be some different options in place there, and that there are a number of different possibilities and for products that combine life and long-term care. So this is obviously a topic we could keep going with. But Linda, I thank you for your time. You've got us all thinking about the future, a little scary. So I'm going to go ahead and turn this back over to Tyler, and he'll wrap up, and we'll be right on time. And again, thank you for joining us. Linda, thank you very much for your expertise and your time.
Thank you so much for having me.
Perfect. All right, so I will close us out now. So on behalf of all of us here at Bryant, I'd like to thank Linda and Robin for a fantastic presentation and Q&A discussion. Most of all, I'd like to thank all of you for joining us today. Please look for that short survey in your email. A recording of this full webinar and any additional information, including Linda's slide that she currently has up right now, will be available on our website. That is at alumniconnect.bryant.edu. And you can access the Career Webinar Series archive under the Careers tab. I'd also like to mention that we are in the middle of scheduling our webinars for 2018. If you are interested in hosting a webinar with us or would like a specific topic covered, or if you have any questions on future webinars, please contact us at alumni@bryant.edu. This concludes today's webinar. Happy holidays, everyone. Thank you, and have a great afternoon.